After China's aggressive stimulus measures adopted on a Tuesday boosted market appetite for risk, the dollar locked its largest one-day drop in months. At the same time, crude oil prices retreated from their multi-week highs. Meanwhile, gold continued to trade near its record high levels of the year. All of these sharp swings secured amid a virtually empty economic calendar. Let's take a closer look at what lies behind this seesaw and how they might impact today's trading. The main news for global markets is yesterday's announcement from China. Beijing introduced a comprehensive monetary stimulus package to support the economy, with the stocks and the yuan benefiting the most. At the same time, the People's Bank of China followed the global trend of the rate cuts and implemented another easing of its monetary policy. This, in turn, technically devaluated the yuan once again. However, domestically, a weaker currency is not a good incentive for buying, boosting consumer demand, which drives an economy's growth. Nevertheless, China still focuses primarily on boosting exports rather than its domestic market. For global market participants, the key focus remains on the interest rates of major central banks, particularly the Federal Reserve and the ECB. The future policy moves by these central banks are based on the incoming economic data. However, with an almost empty macroeconomic calendar and the absence of the significant data, the media has taken on the role of a market expert. As we have seen many times, the media can have a massive influence on the market sentiment, often similar to poor manipulation. In other words, the media can blow up a minor news event at any moment, leading to sharp and unpredictable market price swings. Sadly, this has been happening more and more frequently as of late. This is exactly what occurred yesterday. The trigger was data on the secondary importance, in particular the US Consumer Confidence Index and the House Price Index. The second report looked a 0.1% uptick in housing prices in July, which had previously been flat. Immediately, major American news agencies released articles suggesting that the Federal Reserve would lower interest rates on November 7. Besides, it will be the same outsized rate cut of 0.5%. No wonder the US dollar, which had already lost ground following plunges from Chinese financial policymakers, extended its weakness. However, today its index against six major counterparts is trading higher, within an intraday corridor of 100.20 to 100.40. At the same time, the US dollar index remained close to 100.30, its lowest level since July 2023. Its slight upward momentum can be attributed to anticipation of the upcoming US economic data and remarks by Federal Reserve policymakers scheduled for today and tomorrow. Given yesterday's reaction today, it makes sense to pay attention to new home sales in the US. Analysts reckon a significant decrease. If it comes through, the US dollar will fall lower. Concerns about the slowdown in the US economy dampen optimism about the global growth prospects. Hence, Wall Street's reaction to the weak dollar also looks modest. Nevertheless, the S&P 500 index today showed growth within an intraday corridor of 5,698 to 5,735. Given that the EU has to deal with the numerous economic woes, European stocks opened on Wednesday in the red. The euro has been holding near 13-month high, reached the last month against the US dollar. During the bullish momentum, the euro-dollar pair almost reached the around psychological level of 1.1200, indicating traders' interest in the long positions. A closer analysis of the forex market shows that the euro's rise was driven by a broad sell-off of the US dollar. For the euro to strengthen further, the bulls needed to break through 1.1200 and settle the price above this critical level. If successful, the instrument could attempt to reach a new high, surpassing the level set in July 2023 at 1.1276. Otherwise, the currency pair may have a downward retracement within an intraday range of 1.1182 to 1.1202. Unlike the euro, oil prices didn't benefit from the dollar's decline or the prospects of a revived Chinese market. The Brent price crude did reach the resistance area of 75 and 76. So the buyers cut the long positions and the price sank below $75 per barrel. For Brent to continue its upward cycle, it now needs to stabilize above the level of 76. Otherwise, the above-said range could act as resistance again, potentially ending the current uptrend. In theory, oil has a chance to rise further, supported by the US inventory reports. According to data from the American Petroleum Institute, oil inventories fell by 4.3 million barrels last week. Now investors are anticipating similar data from the US Department of Energy, which will be released at 14.30 GMT plus 3 and expected a decline over 1.2 million barrels. Bearing in mind yesterday's data, the decrease could be more substantial, which would be allow price to rise to $76 per barrel. In fact, Brent already tested this level yesterday, but so far without success. Amid the fluctuations of the euro and the dollar, the Russian currency is showing resilience. However, today, there may be factors that could at least trigger local volatility for the ruble, particularly spikes in the ruble-dollar pair. This could happen due to the industrial production, where growth rates are likely to slow from a 3.3 to 3%. It's a highly optimistic forecast. Some believe that industrial production could slow down to as much as a 2.4%. No doubt, a sharp decline sets the stage for potential weakening of the Russian ruble. As for the yuan-ruble pair, there have been recent surges in the long positions. However, no significant changes are visible on the trading chart. Excluding local price fluctuations, the instrument remains at about 13. The fact that the price is holding above this level indicates an overall bullish sentiment among market participants. So that's all for today. We keep monitoring the financial market situation. Subscribe to our channel and see you online tomorrow.